At some points, you can use a cross-market analysis to generate a leading indicator. Kind of the model that I showed before, Forex, interest rates, stocks. Well, if you're trading the bond market, as we were just kind of talking about, and you start seeing the dollar appreciate, and that leads, then you can start thinking, okay, well, where's that money going? Is it coming into the bond market? If so, I can position myself to take advantage of a rally there. Sometimes that can be a little bit tricky in terms of the way the timing works out. Sometimes they just basically all move together. Depends on the drivers behind and how quickly and kind of edgy the market is. The more complacent a market is, I think the more lags you're going to see. If people are relaxed, they're not going to be so hyper reactive to any piece of news that comes out or any kind of development. If they're relaxed, they'll take their time, look through things, try to understand what's going on, and then slowly make their plays. So, back before all of this started happening in 2007, you would have seen a bit more lag between what was happening in just 2007 was a perfect example. You saw everything develop in the dollar and the rate market, and then it was a little while before stocks caught on. All right, because people didn't really have that mindset of being worried about it until later on when they started catching up and, okay, the housing market's falling apart and it's impacting all these stocks. More likely, what you'll see or what you'll be able to use cross-market or intermarket analysis for is confirming. If oil is going up, is the dollar also going down at the same time? Like today being a perfect example on the data. Oil went up first, but the dollar didn't really go down. Non-confirmation. In which case you start wondering about what's happening. If the dollar had gone down as well, at the same time oil was reaching 70 and getting through 70, then you have confirmation, and that gives you valuable information. That you're probably in a pattern continuation, a trend continuation, at least in that short-term basis. I think for me, the most powerful part of it is that divergence side of things, though, where one market is doing one thing and the other one's doing something else. And to bring back some of the charts we were talking about, for example, the divergence that happened earlier this year between oil and the dollar. When oil was spiking up, as you can see in the left-hand chart, oil was spiking up to new highs, and this is OIL, so your price scale is a little bit different. But running right up to make new highs, and I think this was when Goldman Sachs was saying oil is going to go to 300 or some just completely out there level. And at that same point, the dollar was not spiking to new lows. And in fact, it had already started turning around. So you get divergence, non-confirmation. That tells you patterns starting to change. And this goes back to what I said in the kind of the values of cross-market analysis. When you see the pattern starting to change, you know that some of the things that you've perhaps been trading through that point, either the trends you've been trading or short-term patterns or whatever, are probably going to start breaking down, or at least shifting how well they start to move. Maybe the volatility isn't as great, or maybe the volatility is even more, depending on which way you're playing it. But in either case, you've got valuable information here saying there's something that's no longer the case anymore. The gold-oil relationship has shifted, and you can go, if you have the inclination, if you like the fundamentals and you like the economics and whatnot, you can start digging in and seeing what's happening between the two markets that might be causing that. I think in the case of oil, we could kind of look at and say there started to be that concern about demand because of weak economies around the world, and that really helped pull things down. And right now the pattern has been, okay, well, everybody's starting to improve a little bit and demand's going to start coming back, and that's kind of played through the rally that we've seen since February. Well, it depends on what you're playing. Well, you can always start with the dollar or the currency market, depending on what the basis is. Just as the kind of the top level, like I said, pattern before, things tend to start to happen in the currencies before they start to happen in the more localized markets. And in this case, that's exactly what happened here. The dollar turned before oil did. So, and that's just basically the capital flow and supply demand consideration around the world. If the dollar's rising, that means money's flowing into the dollar. Where is it flowing out of? It's got to flow out of somewhere. So that would be the starting point, but it kind of depends on what you're trying to play. Like I said before, with mortgage rates and home builders. Well, you'd want to watch the mortgage rates as a potential leading indicator, or in fact the interest rate market period as a potential leading indicator for what's going to happen in the home builders and the construction stocks and in those related industries. So it's hard to say this or that specifically. If you talk in broad macro terms, then you generally want to start with the currency market and or the interest rate market, because the two most of the time are very, very tightly linked together. All other things being equal, the higher the interest rate of a currency, the stronger it's going to tend to be. And that's one of the things that kind of played out in the dollar equation before, with the Fed being so aggressive cutting rates and everybody kind of lagging behind. Lower rate means less attractive currency.